Now that we have established the next winner of the market, we are back again to discuss upon value and growth. So, my dear investors, there are times when value investing works very well, and there are times where growth picks up over value. So, what to choose is the question of the hour. This will be discussed by none other than industry expert Mr. Anand Shah, Head PMS and AIF Investments at ICICI Prudential AMC Management. ICICI Prudential Asset Management Company is a leading asset management company in the country focused on bridging the gap between saving and investments and creating long-term wealth for investors through a range of simple and relevant investment solutions. Let me also take a moment to introduce Mr. Anand. Mr. Anand Shah has over 20 years of experience in asset management across Kotak AMC, ICICI Prudential AMC, Canara Robeco AMC, BNPP AMC, NJ Asset Management, and now back with ICICI Prudential AMC to head PMS and AIF investments. He is a recipient of CIO of the Year award for 2 consecutive years, 2014 and 2015, from Asia Asset. Now I'm handing over the mic to Mr. Vikas Agrawal, who will in turn be handing over the mic to Mr. Anand Shah. Over to you, sir.
Thank you, Pragya. Anandji, can you hear me?
Yeah, I can hear you. Can you hear me?
Yeah, I can hear you. It's always pleasure listening to you, sir. And thank you so much for accepting our request and taking the time out from your busy schedule and joining this session.
Sure.
Yeah. So basically, we thought, there is always this debate. There is one school of thought that people say value is a good strategy, and this value, the word is originated from Benjamin Graham times, when he says that everything was cheap and they were buying and accumulating. And the whole thought process of Berkshire Hathaway's during that time was more tilted towards value style. On the other side, you saw that some emerging markets shaping up well. You saw people move to growth side of the story, and there's another camp which talk about only the growth. Growth only delivers and nothing else. And then there are some contrarians also, who would go against the market thought process and take their own bet based on their own conviction and their first-hand research, and various methodology which is being used by their investment team. We thought, who would be the better person than you, sir, to talk about these three things? Whether value works, growth works, or it's good to be contrarian, or you think where is the growth opportunities in India? So with that, I leave this floor to you, all yours. And if you wish to present anything, please, you can present. Thank you.
Sure. Thank you, Vikas, and thank you, the team, AIF and PMS experts, for having me here. Always a pleasure. So what I'm doing, look, there is a lot of fluidity between growth and value. There's no single definition which works all the time. And obviously, there are transition in the businesses where they move from growth to value and value to growth. So that's another challenge. A certain company would be a growth company today and will become a value company tomorrow, and vice versa. So we have in our own country seen the times like 2007, where many of the so-called cyclicals were trading at 70 PE, and many of those growth businesses which are today trading at 70 PE were trading at 20 PE. So it's in that sense very difficult to define or predefine anything as a growth and value. But let me do some effort. So I have my presentation. It will be quick, 15-20 minutes. It will give you some flavor. I don't know if So you can see that here.
I can see your screen. Yeah, very much.
Yeah. And what I intend to do is. I hope.
I can see your screen.
Perfect. And hope the screen is moving, right? It's moved to the next slide.
Yeah, it's moving well. Yeah.
So what I want to do in next 15-20 minutes for you and all the audience is to try and give some indication or some sort of my understanding of the investment style, and we'll wrap it up with some examples of how we see the markets today and which of the styles we are sort of gung-ho on. So let me first start with a very simple definition of the wealth creation. The wealth creation is a two-part journey. One is a growth in the business, the other is a growth in the perception or the multiple of that business. So this is as simple as it gets. We all know price of a stock is nothing but EPS, which is earnings per share multiplied by PE multiple. And any growth in the value of a stock, or for that matter, any growth in the value of markets, is function of one, change in EPS as the earnings per share or the profits of the company go up, your earnings per share go up. And second uh, would be PE multiple, uh, which is where perception of that business has turned. One which was perceived as growth is now being perceived as value, and vice versa, as I spoke before. So there is also a change in the PE multiple, which typically also, among the many things that matter in PE multiple, also matters is return on equity. So I think that's another thing where if there is a structural change in the return on equity of the business, we will see a structural change in the PE multiple of that business. So I think these are the two sources of earnings per share. And if you see over a very long period of time, a large part of growth in the stock market has come from price EPS and very little from PE. But when you see sub-segment of the market, there has been a drastic change. If you see over the last 15 years, when we took the top 500 companies by market cap in NSE, uh, and if you identify the businesses which have around nearly 200 plus companies which have done very well or outperformed Nifty, uh, they have a combination of one. If you see the column uh, 3, this is the column I'm talking about. PAT growth is the single most important factor. The higher the PAT growth over a long period of time, is higher the returns. The other one is obviously the return on equity. The return on equity of the business, higher the better, and to that extent, that explains the PE multiple of the business also. So these are the two key drivers. And the last but not the least, the starting PE multiple. What did you pay for buying a business which has a good earnings growth rate, good return on equity, and what is the price you paid at the beginning decides whether you have this in your portfolio or whether you have these stocks in your portfolio. And as an asset management company, our single-minded focus is to identify these businesses and to eliminate these businesses from our portfolio. I think this is what we do day in, day out. We day in, day out keep on looking and identifying businesses where there's a PAT growth, where there is an improvement in ROE or at least stability of a high ROE, and the starting PE multiple is cheap. Let me move then to our topic, which is value versus growth. And if I were to simplify that significantly for you, for the value investor, the delta EPS is obviously it is important when you invest in equity, but it's not really significantly high. At times in a value portfolio, you might find a delta EPS which is lower than the benchmark. But I think what you would incidentally find in a value portfolio is it's significantly undervalued. Means the PE multiple is far cheaper or a price to book is far cheaper. The stock is underpriced. And to that extent, there is an opportunity if the business fundamentals improve a little bit, you will make much more in PE re-rating than in the delta EPS. Whereas for the growth investors, I think compounding is very important. Delta EPS is very, very important, and you're ready to pay the price, which means the pricing generally can be fair or even overvalued. But you are of the belief that the earnings growth is so superior that even if the PE multiple of uh, that business comes off over a long period of time, you will still end up making decent money. Obviously, there are risks in both of them. In one, you might end up being in the value trap where the valuations are low for the right reasons. Business does not have earnings growth. On the contrary, business might have actually the degrowth. This is what we've been seeing, that there are businesses which end up becoming zero because their earnings growth becomes negative permanently. So I think those are the value traps you want to avoid. Where you pay significantly higher price for the compounding is where the risks are very high of uncertainty in earnings in this current environment where things are very volatile. You find a significant loss of capital because of derating. The contrarian style of investing is actually betting on both. It is betting on both delta EPS as well as delta PE. Here we are trying to identify the underappreciated growth. What we believe that the market is believing that this set of businesses cannot deliver good growth, and to that extent they trade at a discount to what our perception or our reading of the economy and the sector and the company is. So here it's actually the businesses which are underappreciated for growth. They will outperform on EPS growth rate, and they will also have a re-rating as the ROEs of these businesses improve. So contrarian style of investing is actually further ahead of value and growth. And I will talk about it a little bit in my subsequent few slides. But what we are talking about is the businesses where they're not trading really cheap like the value portfolio, but they're trading at a fairly lower intrinsic value than the uh, value that is can be defined through the growth that we see in this stock. So it's more of a GARP style. It's a growth at a reasonable price. This is generally decided. I would try and define the contra in that sense. And uh, what happens at times, the turnarounds, the appreciation of the growth opportunity in this business can take a little long. So the risks are that at times it takes longer than you believe for these stocks to being appreciated by the marketplace. So I think that's a challenge in the contract. So all three are somewhere overlapping with each other. There is nothing called a stock will remain value forever, or a stock will remain growth forever, or will remain contrarian forever. But I think at the time of investing, it can be in one of the three buckets. And we believe the risk reward is far superior in contrarian style of investing is what we follow, where we get benefit from the higher earnings growth than what market is expecting, and also the re-rating, which means the higher PE multiple that the market will offer. At ICICI Prudential, we follow this BMV model to consistently identify businesses where you have a meaningful earnings growth rate, higher delta EPS, and we have a sustainable competitive advantage, which means that the return on equities of business can remain high, which means a higher PE multiple. So how does the BMV work? Basically, we look at a very large number of companies that are listed, and then we prune it down to say 500 odd businesses where we believe the business management and valuation all are three good. How do we define what is good in business and what is good in management and what is good in valuation is where the entire asset management business and its team of analysts, team of fund managers, uh, and their experience comes into the play. So we are looking at business, we are looking for growth, we are looking for sectors growing faster than GDP, we are looking for companies growing faster than sector. Secondly, every business that we own needs to have a certain economic mode, certain sustainable competitive advantage. And if you don't find those things in those businesses, we don't care for management and valuation, we'll reject those ideas. So it's very important that every business that we buy needs to have a good business, good growth, good moat, and consolidation of the industry. I think that's a very big driver of the wealth creation where the industries consolidate. You have better pricing power and better return on equities in times to come in the industry which is consolidating. So I think first and foremost, we identify good businesses. If we don't like the business, we don't go further and analyze management and valuation. Once we like the business, then we go to management. In management, again, with our experience, we are able to gauge with our research, we are able to gauge the competency of the management and the corporate governance of the management. These are the two things which matters a lot. Once we like business and management is then when we move to valuations. We understand the good business and good management doesn't come cheap, but we are not ready to pay any price for good business and management. A reasonable price, a fair price or reasonable premium is acceptable to us, but if it's an extremely high valuation, then we again ignore. So this is what in a nutshell is a GARP, in a nutshell is our style of investing where we are. So let me give you one example which will make this very clear for you. And then we will be left with say another 5 to 10 minutes for some Q&A. Is that okay? So hope you're able to hear me, right? Vikas? Hello? Yeah, so let me move ahead. I understand you are all able to hear me at this point of time. So that moves to the changing trends, and this is one typical example I wanted to share with you how the contrary investing works.
Yeah, I can
So
listen to you and please continue, sir. Then
yeah,
I'll be asking you
thank you very
questions
much.
in 5 minutes. Yeah.
Perfect, no, understood. Thank you very much. So you know, this is a very telling slide about the India Inc.'s earnings growth rate. If you see prior to January 2020, since when we have been in the midst of a macro turmoil, I think the challenge in the earnings was very high. The India earnings growth rate actually was very low across large cap, mid cap, small cap. It's a very interesting thing to see that in the environment when macro was okay, earnings growth rates were really challenged. If you see, while the markets were doing okay, and surprisingly, when actually we are in the midst of COVID and COVID wave two, and we had more recently the Russia-Ukraine crisis leading to high inflation, high interest rates. We actually have a very strong earnings growth rate. I think this is a big trend change that we are seeing. This is a big driver of the markets that we are seeing today. And if I were to drill down it a little bit further, there has been a big trend change that is happening. So prior to 2020, uh, we did talk about the Ritik stocks. If you remember, there were only some set of businesses which were doing very well. Which, for the simplicity sake, I would say it's a consumer-facing businesses. The B2C businesses were doing very well, and actually the manufacturing, mining businesses were doing very badly. The non B2C businesses were doing very poorly. I think this is a big trend change that is happening. We've been talking about it for the last 2 years. That we believe the manufacturing, the B2B businesses, the mining businesses actually have an upper hand in next decade, while consumer-facing businesses will continue to do well, and they're still doing well. They would be actually growing slower than the overall earnings growth rate. If I were to drill down that further into segments of the market, if you see, autos were the best performing, followed by energy and FMCG, and banks were one of the lowest performing businesses in terms of earnings growth rate, followed by infra and IT and commodities. Surprise, surprise. If you see from 1st Jan 2020 onwards, you have autos which are struggling a lot. These are consumer facing businesses, and you have banks which are dependent on manufacturing infra for their profits. They have been seeing good recovery and they're doing extremely well. Ditto for something like metals and commodities that are also doing very well. So I think this is a big trend change I wanted to speak about, and this is underappreciated in the market even today. It was underappreciated in the market 2 years back. It remains underappreciated in the market even today, because if you see, the market cap growth rate is actually lagging the earnings growth rate when it comes to non B2C, whereas there's no de-rating that has happened in the B2C businesses. Their earnings growth rates and market cap growth rate remains the same. If I were to show you on the sector level, again, there has been very clearly lower price to earnings, or a similar price to book for the bank stocks, even after doing extremely well with one of the lowest net NPAs as we speak. And the profit growth rate has been phenomenal in last 3 to 4 years. Same applies for metal, same applies for commodities or infra stocks. So I think that's why I'm saying they are underappreciated even today after they're doing extremely well over the last 3 to 4 years. Whereas if you see somebody like Auto and others, we have seen an expansion in the PE multiple for these businesses. It's ditto for pharma, ditto for IT, where the PE multiples are actually expanded for them as we speak. Lastly, just wrapping it up, talking about the contra opportunities, we believe the strong earnings growth rate and improvement in ROE will be able to find in many of the sub-segments of the market. Particularly, we are very, you know, optimistic about manufacturing, exports, and import substitution. Also, some high discretionary spending. That's where we see opportunities within the consumption space. The opportunities in consumption are far and few, but some of those where the penetration is still low, we'll be able to find some high growth businesses. Otherwise, the consumption should have a far lower growth than what we've seen in the last decade. Also, investment would pick up. China plus one, Europe plus one would lead to a lot of capex in this country, and that is where we see opportunity. And last but not the least, on the back of uh, you know formalization of the entire economy with GST and others, we see opportunities in unorganized, organized, and in geopolitics-led opportunities. If you see our portfolios, we are today among a very one or two asset management companies where we believe manufacturing is the place where we want to be. So we are significantly overweight on manufacturing and significantly underweight on consumption as we speak. And when I say manufacturing, it includes even the manufacturing aligned businesses, which includes the banking, logistics, industrial products, capital goods, utilities. So both manufacturing and manufacturing allied is where we see opportunities, where we will see delta EPS as well as delta PE opportunities, bottom-up opportunities to identify in those businesses, and that is what we've been sort of focused at this point of time. So with that, I'll stop here, and I hope I've been sort of able to, you know, I'm hopefully able to explain the nuances between growth and value, where in growth, delta P, EPS matters more, in value, delta PE matters more, the change in the PE multiple, change in the price to book multiple. But in the contrarian opportunity, we are targeting both. We're targeting businesses which are perceived to be low growth businesses, but they can become a high growth business. And when they become high growth business, they have a higher earnings growth, but also they have improvement in ROE leading to higher PE multiple. So with that, because once again, thank you very much for having me here. I'll
Thank you,
stop here
Anandji. With
and
your
see.
permission, can I take few questions
Yes,
quickly?
definitely. Yeah, sure.
Okay. So the first question is, can you throw some more lights on Contrarian approach? How do you select stocks?
Yeah, so as I said, there has to be an underappreciated growth. So obviously, we are very focused on identifying growth. Also, importantly, we are also focused on identifying high mode businesses, because at the end of the day, to have a growth without any entry barriers is disaster, because then it will attract a lot of competition. You need to have certain entry barriers in your businesses. So the moat, as we call it, or sustainable competitive advantage, as we call it, is very important for a high return on equity in the business. It's very important, and that's why our approach is to identify segments of the market where the growth is much higher or will be higher than the perceived growth by the markets. Plus, the every business that we invest a bottom up approach, we look for more sustainable competition. And lastly, most importantly, I'm talking about consolidation of the industry. Typically, a consolidation of the industry is where the wealth creation is higher. Fragmentation, when happens in the industry, there's a wealth destruction. So that's the third element, which is very important element in wealth creation, where we keep on looking for business where the number of players are reducing, the weak players are exiting, they're gaining market share. That's what has happened in India. Say in steel, so many steel companies have been acquired by large guys, or same has happened in cement. Even in banking, if you see, the big banks have been able to become bigger and bigger, and incrementally they account for a large incremental loan growth. So in many of the businesses, we are seeing this consolidation, which is in turn driving higher profits and higher return on equities in this business.
The second question is, we see value investing underperforming, particularly in country like India, at times for many years. What's your views?
Yeah, India is a growth economy, and definitely the institutional investors, especially foreign institutional investors, are looking to India for growth. Uh, they, they're not coming here to do value investing, and to that extent, the followers of value investing in India are far and few. And obviously, people are looking for growth, and India obviously offers a lot of those opportunities where the growth is significantly higher than the GDP. Having said that, if you see last 2 years, it's been exactly opposite. All the growth stocks, the high PE stocks have corrected 20-30%, whereas the low PE value stocks have done very well. So yes, it's not only in India, globally also the value stocks have underperformed as the interest rates have gone to zero over a 13-year period since almost I think if not more, at least from GFC, we are seeing the interest rates have been fairly low and only going down. And to that extent, Yes, the value investing has suffered over a growth investing, but in last 2 years, as the interest rates have gone back up, we are clearly seeing the signs where growth investing is suffering and value investing is doing very well.
Yeah. Next question is, what are the key indicators to rotate your portfolio from value to growth and growth to value?
I think more than between value and growth, I think we keep on looking for growth stocks which are underappreciated. I think if you buy into a growth stock which is significantly appreciated, trading at a very high PE multiple, the risk reward is not favorable. You might end up making money, but it will be very risky because if a lot of growth is priced in, and then if you were to even disappoint for a quarter or two, we have seen in last 2 years how a sharp correction on those growth stocks have happened. So to me personally, the smart thing is to keep on looking for underappreciated
So
growth.
Anandji, there is
Keep on
this
looking for
different school of thought, as in there are few. Can you hear me?
yeah, I can hear you.
Who say that always you can buy good quality stocks at any price. Do you agree to this thought process?
No, again, we are not of that school, and how much ever good business, how much ever good management, how much ever good business or how much ever good management, you need to buy them at a reasonable price. Otherwise, uh, you know, and that's been the experience for last 2 to 3 years. We have seen quite a few businesses underperforming significantly, including the new tech businesses. If you recall, when this startup industry came into and started getting listed, people thought that you can pay any price for any business, but that was not true. Similarly, in last 2 years, you have seen many growth stocks at a very high PE multiples have significantly underperformed as the interest rates have moved up. More importantly, the input cost deflation has now become input cost inflation. You also had a benefit of China exporting deflation to the rest of the world. That's why consumer-facing businesses did well. Whereas, whereas today, as we speak, as China exports inflation, the consumer-facing businesses are suffering, but the manufacturing businesses are doing extremely well. So that's a change in the trend which needs to be appreciated and incorporated in your portfolio. So there is no one thought of saying high quality business at any price will make sense. It has not made sense in the past, and we believe it will not make sense into the future also.
Would it be fair to say that instead of somebody spending more time towards what is going to work, it is better that you have to have a right balance in terms of growth and value? Would that be a right way from your point of view, Anandji?
So I think we are very clear. We continuously look for businesses, whether in value or growth. As I said, they're fluid. Look, many of, as I gave you an example in 2007 also, you had an L&T trading at 50 PE plus and actually HUL trading at below 20 PE. And vice versa, today you had L&T trading below 20 PE multiple and HUL trading. So there's no permanent value or growth. You have to keep on looking for businesses where uh, in the current market price the growth that is factored in and actual growth would be higher than that. And for that we do a lot of research. We have team of analysts who keep on looking for opportunities where the earnings growth is higher. To give you an example, today we have more manufacturing in our portfolio because manufacturing will benefit not only in India, globally, ex-China, because China's ability to continue to manufacture at a low cost is now behind them. Their labor cost is going up, their interest costs are going up, their energy costs are going up, their pollution costs are going up. So whichever way I look at it, uh, for the manufacturing that has survived last decade and a half, I think the earnings growth will be far superior, and which is today underappreciated in the market. So you have to identify growth pockets which are underappreciated, either in growth area or a value area. As again, I'm saying there's no clear definition that this stock will always be growth or this stock will always be value. You have to
All right.
identify stocks moving from value to growth.
Sure. All right. So with that, we'd like to conclude the session here. It was great interacting with you, Anandji.
My
The best
pleasure.
performing portfolio manager when you look at 1 year, 2 year, 3 years down the line. So I would say congratulations and many thanks to you for to be able to create well for our investors, which is most important, and all of us are involved in doing so. So, on behalf of those investors, I take this opportunity to thank you for doing a fantastic work.
Thank you, Vikas. Thank you for having me. And thanks to everybody, one and all, who joined for this call.